the core element really is that as a business model, having a royalty or a stream interest does generate cash flows that have a different risk profile to an operating interest or to an equity interest.
There's a certain flavor of the month element. At any given point in time, there's a hot sector, a hot commodity, and the capital is flowing freely. So, the message you get from brokers and bankers is, if you're raising money for this type of project, we can raise a lot of money for you.
I think what investors really are focused on is the strategic value of the business, its growth prospects, and how it fits into the overall scheme of things. I mean, what we've seen when we started Nova, we wanted to focus on copper because we felt that commodity would become as important as anything out there, just given its role in greening the world.
I'd like to welcome you all to another Assay Live and one-to-one APAC online webinar. This one is focusing on royalties and streaming. So is this a growing trend in financing? Joining us here today, we have Julian Andrews, Managing Director and Chief Executive Officer at Deterra Royalties.
Morning.
Morning. We have Kevin McElligott, Managing Director for Australia at Franco-Nevada Corporation. And Alex Tukurnik, President and CEO of Nova Royalty Corp. So thanks everyone for joining us here today.
Well, thanks for the invite.
Good to be here.
And so back in 2021, some studies were suggesting that royalties and streaming financing deal flow was set to really take off over the next decade, expanding across different commodity markets and geographies. And towards the end of last year, we saw a pretty big uplift in the share prices of many royalties and streaming companies. I thought it would be a good idea to start the webinar off by looking at some of the recent trends in deal flow for streams and royalties that our panelists have seen lately. How has the recent commodity price volatility impacted deals, valuations, and forecasts? So maybe Kevin, if you'd like to kick us off there.
Oh yeah, look, that's a big question. I could talk about that one for half an hour, but I won't. In terms of recent trends, look, when you talk about the volatility has largely been on the upside price-wise. We're seeing commodities hitting record prices. So what that does with deal flow is that activates a whole number of projects that were previously just sitting on the sidelines and motivates capital going into the sector. So sometimes, just to draw the opposite perspective, when there's bad times and companies need to refinance, they might look at streaming deals to repair the balance sheet. But that, I don't see that being the case or the general case right now. It's more the opposite. It's more companies that are trying to move projects forward across a variety of commodities right now. So we're seeing a lot more non-gold projects coming through. Simply because the best example I think last week was nickel. It hit $100,000 a ton briefly or something on the LME, and I think it might have settled at around $40,000 a ton, which is still a ridiculous price. But there's a whole lot of people with nickel projects that are looking to put capital in them now. So we're trying to get involved in some of that if we can.
Yeah, and perhaps, Amy, if I might just add, absolutely agree, Kevin, that the strong commodity pricing certainly creates a broader opportunity set for all royalty and streaming companies in terms of those opportunities to provide funding. I think the other point to make perhaps though is that when you're looking at these investment opportunities, typically you are looking at a long-term investment. So that short-term volatility certainly drives sentiment in the long term, but what's important for us is to really look through those short-term fluctuations and look at the long-term fundamentals of a project and fundamentals of a commodity in terms of its performance over a longer period of time.
Yeah, I'd like to second that as well. I think for us, not much has really changed. It's really just about the projects, and if you can get access to the projects you want, you do that deal in a good market or a bad market. It's not something you really pay that much attention to. I mean, the other thing I think is that the cost inflation right now is more than keeping pace with any price increases. So as far as the project's viability, even though you're seeing higher commodity prices, you're not necessarily seeing more viable projects because the cost inflation is likely to be much more permanent than any sort of price increases that have been quite explosive.
Interesting. You bring up kind of cost inflation. What are some of the impacts of that on existing royalty deals and also for originating new ones?
I think. No, go ahead.
Oh, go ahead, Alex. That's fine.
Yeah, it's it just changes your whole viability calculus. Because if you're, for instance, Nova, we're much more focused on the development end, and so we've focused very much sort of on really blue chip copper projects because we felt that those would get built. But even those projects, they're going to cost more. The companies that have them can build them, but again, it just reinforces the need for a top tier operator and really compelling capital and cost profile to be an investor on the royalty side of it, because that's what you depend on.
Yeah, and exactly. And in terms of the impact on existing instruments, to the extent that you've got a revenue royalty, that there's a large degree of insulation from cost inflation. So often, royalty instruments, particularly revenue royalties, can be very good protection against the cost inflation side of things. You don't have that exposure to the operating margin, but at the same time benefiting from any increase in commodity pricing that cost inflation may be driving.
So something that was brought up earlier was kind of this move away from gold projects, kind of an expansion of the royalties kind of industry beyond gold. I suppose it's historically been gold focused, but I'm thinking about kind of growth strategies for royalties and streaming companies. Where are you looking for opportunities? Are you diversifying more? Are you seeing the industry overall diversifying more to kind of have a broader commodity remit?
Yeah, I can talk to that. Look, we've got a pretty diversified portfolio, with 400 projects that we're invested in. But even then, we try and maintain it. Well, we do maintain a precious metal focus. I think it's currently around 70, the high 70%, 77, 78% precious metals. And the rest is, really diversified, largely oil and gas, but a bit of everything in there. And certainly we have many opportunities to invest in other commodities, and we have to restrain ourselves to maintain that gold focus that we're never going to change. That's there permanently for us. We're just too in love with gold. Right now, I'm a bit jealous of the non-precious metal focused guys, because they probably have a more target-rich environment. They don't have one hand tied behind their back, so they can actually look at everything. I think one larger comment, and you other guys might want to speak to this. I've always thought that, particularly on the streaming side, whoever got involved in streaming on oil and gas projects, that would become the biggest royalty and streaming company in the world, simply because of the size of the projects. It dwarfs the gold sector. But the problem is now there's a reluctance to put capital into fossil fuels long term. So when people are trying to find the energy alternative to invest in, that's going to be the long-term energy alternative. And whoever starts doing streaming deals in there, that's going to be huge, because there's a phenomenal amount of capital that's going to be going into that in the next, for the rest of my life anyway.
Yeah, look, absolutely. In terms of our focus on commodities, we are sort of consciously not chasing those precious opportunities, the gold opportunities that Kevin was speaking to. So, we have our cornerstone is in the bulk space in iron ore, and so we're looking to build around that, and certainly looking at some of those other commodities that certainly historically have perhaps been a little less well served by the royalty and streaming sector.
Yeah, for us, we're 80+% copper, with the remainder nickel. And so copper is really our focus commodity. It's a little bit different within copper because you have fewer projects that are much larger, and there the opportunity is very much more on the royalty side versus the streaming side, just because very large mining companies don't generally stream their primary commodity directly. And so, but again, I mean, obviously with the fundamentals of the energy transition and the like, there's some really exciting things to do.
Absolutely. So I want to just give a reminder to our audience that we will take questions as we go. So, if you have any questions that are relevant for the panelists, definitely feel free to type them into the Q&A box. We've just gotten one really quickly. So why don't we address this? So we've been asked, do you see streaming specialization occurring, for example, with industrial metals or rare earths?
I certainly see it occurring. I see companies trying to. They will say that we have a focus, but I think the real test is whether or not they can maintain that focus over a longer period of time. Because every day new deals come across your table, and at some point you're really tested as to whether or not you're going to maintain that focus.
And I think, the greater the degree of specialization, as you say, you're narrowing that opportunity set, and scale is important, and the ability to build a business of scale can be limited if you're too focused in your targets.
Yeah, I agree. I think if you're going to specialize, you need to specialize in something that is big enough to build a sizable company out of. Otherwise, it becomes very bespoke. So I mean, we are commodity specialists, but it's also a very large market. So we're comfortable being a copper specialist. But at the same time, I agree. If you're too narrow, it becomes difficult.
And
but you do need to have that pitch to your investors too. They do need to know what they're investing in. So
yeah, and I suppose some of these industries are significantly smaller and much more specialized.
And part of it's capital availability too. It's there's a certain flavor of the month element. At any given point in time, there's a hot sector, a hot commodity, and the capital is flowing freely. So the message you get from brokers and bankers is, if you're raising money for this type of project, we can raise a lot of money for you. If you're going to continue with this thing that you say that you're focused on, we can't raise any money for you. So sometimes people's hands are forced. And
I suppose in that regard, do you see kind of more focus on kind of the battery metals within the industry? Do you see that taking off significantly?
I don't know. I mean, it's hard to define what that even means. When you look at the energy transition, that's first and foremost a story of copper. Some nickel, and I mean, people talk about lithium, but just market size, lithium is a $4 billion a year market or so. Copper is 250 or 300, whatever the number is. So again, I think there's been a lot of time spent on the so-called battery metals, but when you look at the actual size of the markets and what actually drives it, I think it comes back still very much to the metals everybody knows.
And I think also, that ultimately the activity is going to be where the capital is going, is the point you made earlier, Kevin, about where the money is going to be invested. That's just by sheer arithmetic. That's where the activity is going to be.
So we've before we move on to my questions, we've had another question come in saying, asking, is there any trading valuation premium or discount for non-precious metals royalty companies? So for example, typically the gold royalty companies trade at much higher PE ratios than, say, gold producers. Does this apply to iron ore or copper, nickel?
Look, I think if you look at trading history, there's no question that the large successful precious players do trade at very at high premiums. Part of that, I would suggest, is a function of gold, the nature of gold as a commodity. I think part of it's about the scale that they can provide and liquidity that comes with that. And part of that's obviously a reflection of very successful execution of the business model over time. So certainly in terms of our business, we're a relatively new business. We've been around for about 18 months now. We're looking to bring that model to a slightly different market, both in terms of ASX as well as the commodities we're looking at. But the core element really is that as a business model, having a royalty or a stream interest does generate cash flows that have a different risk profile to an operating interest or to an equity interest. Typically, as I mentioned earlier, if you're driven by revenues, you don't have that exposure to operating margins. Even through an NSR, you've got limited exposure to operating margins. So, it is a qualitatively different cash flow. And as such, we certainly believe that it deserves a qualitatively different valuation approach, and one that brings with it a different risk profile, but a more limited risk profile. And that should support good valuations.
I think I agree with some of what Julian said. I think it's much more nuanced than just precious versus non-precious. Companies like Franco-Nevada, Wheaton Precious, they're phenomenal companies, and they're going to trade at high multiples, and they've had a track record over a long period of time. At the same time, I think what investors really are focused on is the strategic value of the business, its growth prospects, and how it fits into the overall scheme of things. I mean, what we've seen when we started Nova, we wanted to focus on copper because we felt that commodity would become as important as anything out there, just given its role in greening the world and its strategic nature, and particularly when you have scarce deposits that can actually go into production. Again, you're talking about a much more limited universe. So it really comes down to what investors are looking for, and whether the company can excite them moving forward. I think the whole precious, non-precious discussion, I remember when we were going public a couple of years ago and people were still bringing that up. It seemed old then. At this point, I'm not sure it matters. You really need something clear.
Yeah, I guess as a gold guy, I should comment on just non-precious thing. But I will say, I think if I understand the question correctly, yeah, I think there is a premium for royalties. There will be a premium for gold royalties over gold equity, same way, and there would also be a premium for a copper, iron ore, or any base metal royalty over the base metal equity too. Partly that's a function of just the risk, like you said, but also if it was the other way around, the royalties would all just got bought. It would just be bought out. The operators would just buy them back, and there wouldn't be any for. They would be the ones with the winning bid in the market all the time. So.
Sorry, go ahead.
Yeah, I was going to just chime in here for it. What has happened in the last couple of years is that royalty companies have come mainstream. And so now they're really just, in many ways, the best way for investors to participate in a specific commodity. And given the fluctuations you see in the commodity markets and their overall just much more important role in the world today, you're going to see, I think, very large movements in the sector that are probably unlike anything we've seen to date, just because all of this is coming to the fore much more. And commodities were actually a pretty small part of the global economy up until recently, and still are. But now that investor interest is going to be coming to the fore, you're going to see moves and valuations that you probably haven't seen before.
So why, I suppose my question is, why is royalty and streaming kind of gaining such ground these days as a form of financing?
Well, I think royalties have always been there, but on a smaller scale. I think it was the streaming deals where you actually get involved in project finance. That's just it just added a level, a scale to the deals that just wasn't there previously. Before, finding a big royalty is really hard. They're pretty small in number. They don't generally change hands very often because it's like the goose that lays the golden eggs sort of thing, or the crown jewels or something. But when you get into stream finance and financing new construction or new projects, well, that's a whole different ballgame. The dollar amounts are bigger, and at any given point in time, there's a lineup of them to look at. So I think that's, in my mind, that's what really changed. That's what really changed it for us. I mean, we only started doing streaming, 10, 12 years ago or so, or maybe a bit more, 13, 14. and already our, the stream deals are very quickly, we're, 50% of company revenue or more. And caught up to a portfolio of royalties that we'd spent 20 years building. So.
For companies, it introduced a whole new way of financing themselves without diluting, which became very attractive, particularly in difficult markets. And because the royalty and streaming companies have traded at a significant premium to the producers, you're creating a good meeting point somewhere in terms of cost of capital. So if you have producers that are challenged on the equity cost of capital, and you have the streaming companies that have a lower cost of capital, it creates a natural meeting point for a deal that maybe didn't exist before.
So we had a question coming that came in advance, asking, streaming has traditionally been applied to byproducts. Do you see any kind of additional risks or opportunities for streaming to be applied to primary products?
Well, that one's hard. Like Alex said before, operators don't want to sell their main commodity. They want exposure to that, because if you're looking at streaming on the main product, you're really looking at it almost like an offtake deal. So you want to be somebody who's going to be using that product. If you're a smelter or something like that, that makes a whole lot of sense. Otherwise, I think it gets tough. I'm not sure if anybody else is.
Yeah, no, I agree, Kevin. It just the streaming on a primary product is really, effectively you're selling, as you say, a portion of the primary product. That's why the mine is there. Byproduct, it makes a lot more sense. So I can't imagine you'd see too much streaming on primary products.
Yeah, I mean, you can do a reasonably sized royalty on the primary product, particularly on the private asset, where people are less worried about public perceptions of commodity price exposure, as long as the asset has a good cost profile and a deal fits. But in terms of large scale, I agree. I think it's very challenging.
So I want to shift gears a little bit. Looking at due diligence, geopolitical risk, and I suppose are there no-go areas for your companies to invest in, to get involved in? How do you assess that? And are there special considerations for entering into specific jurisdictions like Chile or Peru, parts of Africa? We had a question that came in about, say, Armenia. So how do you kind of assess geopolitical risk in terms of location?
I mean, certainly for us, we do, it is an important consideration. Part of it is about sort of setting the parameters up front. So there are certain areas where we can rule out pretty quickly. We just on a geopolitical or jurisdictional risk element. The other sort of nuance, I think, in this discussion as well, is that when you're looking at a royalty or a stream, ultimately it's a contractual interest. So it's a different level of interest in that mine than you get if you were to buy in at the equity level, for example. So there's sort of two layers there. One is to understand how geopolitical factors might impact on production levels at the mine. And obviously that's a very important consideration. And the other is really, to what extent can you rely on your contractual rights, if you should ever have to at some point. So I think, it's a two-level due diligence process. And as I said, there's some additional nuances to it that perhaps you wouldn't necessarily see if you were looking at an equity investment. But look, we as I said, we have we have areas of focus for us that we're more comfortable in. For us, it's Australia, being Australian based. It's North America, most of South America, Europe. But even things change, as we've seen in parts of South America recently. There can be shifts in sort of geopolitical risks. I think again, typically we'd be looking at long-term involvement in a project. So it's it's important to be able to look through short-term sort of noise, if you like, to understand the sort of the underlying drivers?
Yeah, I think, to me, it's always a size criteria when you're evaluating risk. Certainly, for a larger transaction, where I can only reiterate what Julian just said there. You're looking for places where you can enforce contracts and where the operating risk is perceived as low. But I think at the smaller end, I think people would be surprised at the number of projects that we look at and where they are in the world. And sometimes we very rarely invest in some of these smaller ones, but we certainly do take a look at them. And that's just purely a size criteria. We're willing to place some small risky bets in various parts of the world. But if you look at our portfolio, I think it's 90% North and South America. Between Canada, US, Mexico, Peru, Panama, Chile. I think the biggest, obviously somebody asked about Armenia. Obviously the big one today is Ukraine, Russia. That's, people are thinking about a reset there in terms of risk profiles and sanctions, and what's the knock-on effect of sanctions? Which countries are supporting Russia, and are they going to be Are they going to be hit with sanctions in the next round? Who knows? For us, I don't think we don't have any investments there that I'm aware of, or if we do, they're very small, so I'm not aware of them. The big one for us a few months ago was elections in Peru, where the left-wing candidate was very left-wing, former Marxist sort of left-wing, talking about nationalizing mines and whatnot. So that was a big deal for us. We're heavily invested in Peru. As it turns out, he did win the election, but he didn't get control of the legislature. So, can't really enact much of much of an agenda there. I don't know what else to say. They're constantly being reset, but for us, back to the first point, it was really a size criteria in terms of that's a big part of selecting your risk tolerance.
Yeah, I agree with that. So much of it is just staying close to the situations, and because when the world is changing very quickly, obviously if you deploy anything in size, you need to be much more conservative. I mean, we're right now exclusively North and South America. At the same time, you always keep your eyes open. I think the most important thing for us, much less than the actual country itself, is the social environment in the actual area, because you see so much dispersion within the same country, even in terms of support, local support, how the communities are, the governments and the like. And we find that's actually much more important than what happens in the capital cities, because in the capital cities, you get this much more sanitized version of whatever is often happening on site. So we do spend a lot of time on trying to figure out what's actually happening at the local level.
I suppose, does that kind of leads into somewhat of an ESG question, just looking at how that framework kind of impacts the way that you look at opportunities.
I think ESG has become a very popular buzzword. And people at ESG this, ESG that. I think on the fundamental level, I think you asked the question: do the various people and organizations in the community and surrounding the mine want the mine there? And I think that becomes pretty holistic. I mean, you can tell whether there's general support for a mine or not. And I think, in terms of how we've selected properties, by and large, we try to focus on situations where we felt that was the case. And that's really all you can do. I mean, because again, I think because the mining industry has some excesses in the past, I think people are trying very hard to put their foot forward and saying that they're ESG compliant in every possible way, but it still comes down to the same thing: that people want you there or not. And I think you try to figure that as best you can.
There's also, again, if you're holding a royalty or a stream, typically you don't have any or much, if any, involvement in sort of on the ground operations. So as you say, Alex, it's important how that relationship with the local community and also the broader community is handled by the operator. So a really important part of assessing those is not just the current situation, but how are you partnering with the right operators that's going to handle future situations appropriately as well. So that's a pretty important part of the exercise.
Yeah, I guess for us, it's really changed in how we interact with our own investors. Look, we've always paid attention to the environmental approvals for projects. There's nothing new there, mainly because they're a great source of technical information on the project. But what's changed, and this may be slightly different, for other companies, but we don't pitch ourselves to gold investors. We pitch ourselves to general investors, largely in the United States, but around the world, as a safe place to put their money in gold or in mining, and we pitch ourselves to generalist funds, and they don't know a lot of them. Well, this isn't fair to say. Obviously, there are some analysts that follow mining closely, but some of these generalist funds, they don't actually know a lot about the resources sector and whatnot. And one of the main things we try to avoid is any sort of black mark that will prevent them from investing in us. So we're very conscious of our own policies and procedures and governance, and that has a knock-on effect to the extent we can be selective where we invest. We do so, but you'd be surprised. We're a company with a staff of about 40 people, and you would be amazed at the level of corporate governance and policy and procedures that we've been able to generate internally in order to comply with what's coming down from our own investors in these funds, in order so they can tick all the boxes that say, yes, we can buy Franco-Nevada shares. So
yeah, agree absolutely, Kevin. And I think it extends to, certainly from our perspective, it extends even to the kind of opportunities we'd look at. So we have obviously a focus on bulks. We see a lot of thermal coal opportunities come across our desk, but we recognize that it's just not appropriate for us to be investing in thermal coal from our investors' point of view. So we pass on those. But it's a real issue. It's a genuine issue for our investors, and we're very mindful of that. And as a result, we pay a great deal of attention to it, both in terms of the opportunities we look at, as well as you say, Kevin, just sort of the processes and reporting around it.
So we had a question come in asking about originating royalties within the Australian market. So I'm wondering if any of our panelists can talk about kind of some of the key considerations, challenges, and more for this.
Yeah, sure. Look, I'm happy to maybe kick off. We're Australian based. We spend quite a bit of time in the Australian market, obviously. I think it's important to recognise that every market has its own history and its own sort of practices, and there's no question that royalties and streams are a part of the Australian mining landscape in terms of funding, but not nearly to the same extent that they are in other parts of the world. And I think that there's a number of reasons for that. I think at some level there's an issue of the capital availability. So Australia is obviously a very has a long history in mining, and the capital markets have historically been very supportive of mining in Australia. So as a funder, we're very conscious that we are another source of capital. We're competing not just with other royalty and streaming companies, but other providers of capital. And so in Australia, as I said, the equity and the debt markets have been pretty supportive historically. So there haven't really been any major royalty companies based here in Australia sort of marketing the model, if you like. So historically they haven't been as widely used as a funding mechanism. There are a lot around there, but they typically tend to be royalties that are the product of sort of exploration activity rather than as a funding mechanism. But look, I think we certainly believe that royalties and streams have a very important part to play, and particularly when you look at the level of capital investment that's going to be required over the coming years to meet some of the demand forecasts across a whole range of commodities. Royalties and streams can really provide great alignment with a miner or with a developer in terms of getting that alignment between the returns that we earn on instruments and the performance of the underlying mine. So look, it's we see the fact that perhaps the royalties and streams aren't as well used here in Australia as they are in other parts, particularly in Canada and North America. But we see that as an opportunity. That just means there's a greater opportunity set out there for us.
Yeah, I can just
sorry, go ahead.
reinforce what Julian already said. Look, certainly on the royalty side, because of the history, I'd say estimate somewhere between 25-30% of Australian projects already have a private royalty on them, just from the history of tenure and changes of ownership. And at some point in the past, somebody's retained a royalty on it. So there's sort of a steady flow of sort of resale or secondhand royalties out there. And then in terms also because of capital availability, like there's no secret is the reason why some of these big stream deals that have happened in the last 10, 15 years have been largely in places, for instance, South America, where local capital markets don't support big projects, not just mining projects, probably any big project. They need external capital. Whereas in Australia, like if you've got a high quality resource project here, people are going to throw money at you. You don't really need to look at any alternatives.
So we've had a number of questions come in from the audience. So I think I will kind of start to just go through some of these before we start to wrap it up. So one of the questions is asking about silver. So silver has typically sat a bit in the shadow of gold. However, there's been a flurry of silver specialized development and operating activity. So questions just asking, is this an area that has caught your interest? That might be directed specifically at Kevin.
I will confess it hasn't. Mainly because it's really hard to find a high quality silver project. Most of it's lead, zinc, silver, and the silver's, as much as people play up the silver content, it's really the lead zinc that drives it. Vast majority of silver that comes out, silver is a byproduct. We see it would be a great source. We'd love to do a silver deal, a silver stream on a lead zinc project, if we can find one that makes sense. That would be great. But as for pure silver projects, geez, that's hard. That's really hard.
And another question is asking, how important is it for royalty companies to use new approaches to find economic deposits? So such as kind of artificial intelligence or machine learning systems. What about accessing and researching paper-based archival documents? So I think this question is really just asking if there's any interesting stories about the use of new technologies and stuff to aid in your decision-making or approaches.
I think it's
Sorry, Alex, go ahead.
No, go ahead, please.
I was just going to say, I think, certainly from our perspective, as Kevin mentioned, there are a lot of existing royalties out there on projects already. And I think that's perhaps one area where there's data on that, and there's always opportunities to review that data to identify opportunities. Likewise with, obviously developers file their reports around their deposits, and those are obviously an important source for identifying and originating opportunities. But in terms of, certainly from our perspective, we try to keep things simple. we're not sort of delving too far into the AI space to identify new opportunities.
It's a really fascinating subject, I think, because when you look at the progress of the mining industry throughout generations, a lot of it has been made because of new technologies coming in and being able to mine different types of deposits. At the same time, I think it's important when you actually get involved and make decisions based on that. I don't think as a royalty company, you necessarily want to be a first mover in that in terms of doing geological exploration using AI. At the same time, I do think overall the subject is relevant to all of us because you're seeing people trying to get more out of existing mines, given the issues with permitting and increasingly location. I think location is going to drive quality of deposit much more than it ever has. You are going to look at things through a different lens. But again, you only want to, I think, really apply that at a point where it's applicable to you within your business line rather than just something hypothetical.
Yeah,
maybe. Sorry, go ahead.
I don't think royalty companies do a lot of exploration themselves.
Yeah.
So usually we're looking at, we don't have big exploration budgets ourselves. So typically we're just piggybacking on other people's work and just following what other people are doing.
Questions are getting quite specific. I think we are going to start to wrap it up. We do have one question that's really kind of just asking about specific criteria that that you'll use in terms of kind of assessing an opportunity, whether it's in copper or gold. Are there kind of specific requirements that you ask for from an exploration or development company in order to kind of assess whether or not you're able to go in there?
Well, I suspect every company is a bit different in what their criteria are. So for us, certainly for buying a royalty, one of our criteria is there has to be a resource. It has to be more than just an exploration target, and that's a starting point for us. But if you're looking at serious money for like a stream for development of a project, you need a bankable feasibility study. I think there's other companies that might look to get in ahead of the BFS stage at an earlier stage, but that would be pretty rare for us. We prefer to get in at the sort of the final stage, sort of filling the gap where the company's maxed out on their debt availability and are looking at a potentially expensive or dilutive share issue, and then that's suddenly the stream's pretty attractive at that stage. So it's when you've got a pre-feasibility or something, a resource with a pre-feasibility, we struggle to put in significant capital at that stage. Certainly for a stream, we would look at a royalty. So,
and from our other panelists,
I agree with what Kevin says. I think that everybody's a little bit different, and frankly, every project's a little bit different. But what's important is to keep an understanding of what's going to drive the returns on the investment over time, and ultimately that comes down to what's produced and what pricing looks like. Understanding that deposit is pretty key. Understanding its potential, what it could be, as opposed to what it is currently, is also pretty important. So we certainly like to focus on what's in the ground.
From our perspective, certainly in agreement with some of the things that Kevin and Julian are saying. What we really get excited about is if there's a chance to get a scarce asset, because again, in the mining, especially now in the mining industry, there's such a premium for the top end of the food chain, and you're seeing more and more differentiation. So we're comfortable going earlier if we see an opportunity to get something like that at a reasonable price. And again, on the copper side, because the projects are very large, and even the so-called near-term stuff is a good 5-7 years out. you do find yourself acquiring these at excellent valuations that we feel with overall risk levels that are much lower over time than a lot of other things. So as long as we get the quality that we feel is there, then we can be probably quite flexible on the other things.
Great. So that kind of covers all of the questions that I had, as well as the stuff that's come in from the audience. Quite interesting topic. So really thank you to all of our panelists for taking part today. Thanks to our audience for the great questions for everyone. And we look forward to seeing everyone at an event soon. If you are taking part in the APAC event next week, remember to book in all of your meetings, and looking forward to seeing everyone soon. So thank you.
Great. Thank you very much.